Welcome to Beyond the Box, unlocking creative mortgage solutions. I'm your host and creative financing expert, Brett Clark. This podcast is for realtors looking to offer more to their clients and loan officers seeking new knowledge. We'll dive into non-QM loans, creative strategies, and trends to help you grow your business and serve clients better. Let's unlock smarter solutions and build stronger partnerships along the way. Ready? Let's get started. Welcome to Beyond the Box. Now we're going to dive into each individual non-QM product, and we're going to start with the most powerful, in my opinion, and my personal favorite, the DSCR loan, or debt service coverage ratio. So if you work with investors or want to work with investors, this is a must-know option. You have to know this to help people scale their real estate portfolios. So we're going to cover what it is, how it works, and the special benefits that it brings to you to get the investors and the benefits it brings to the real estate investors. So let's get ready to scale up and jump in. So let's start with the basics. DSCR, debt service coverage ratio. It is all about cash flow, specifically the cash flow of the property itself. We're no longer looking at the borrower's personal income, but only the property. And we're going to talk about how it's important to look at the property before writing that offer. This ratio is calculated by dividing the property's gross rental income by all of its expenses. We like to call it PITIA, but it is principal, interest, taxes, insurance, and those HOA or condo fees. Generally, we want to see a 1 or higher, and typically for the best situations, you want a 1.2 or 1.25 or higher, and that really gives that positive cash flow, best rates, best term situation is when you can have those. It's a little bit harder to find those today though. So don't worry if you're not finding those. We have other options for you. There is something that we can do to help investors grow, especially in situations where rental income is expected to increase over time. Some guidelines actually allow us to use a DSCR ratio that is under 1. And this might sound scary for a couple people, but if we know that rent will increase, then we do know that there's that possible chance, but they have to bring a little bit more on that down payment side. So this is perfect for investors who can make that initial investment a little bit higher. They are okay with a little bit more of a premium rate because they know that the market is going to help them with that furnished, optimized product afterwards. Or if sometimes the market isn't as favorable as they think it is going to be. But I do want to hit on one more thing. As you're looking, HOA fees and condo fees can change the entire landscape, that entire ratio. So make sure you're careful and you look at the PITIA. What is that HOA? What is that condo? Because that does play into cash flow and profitability. Super important, but this is how it works. We're just taking that rental income, we're looking at the expenses, and as long as there's cash flow, we're good. So now that we've covered the basics, let's get into some real world scenarios. Where are places that I've actually see this work and be beneficial? So for instance, I have a couple of clients, several clients in the Pinehurst, North Carolina area, super popular golf community, and it's known for short-term rental, especially around the PGA events. So this is a huge area, but those long-term rent comps, they just don't make it for those $1 million properties or the houses that are in those golf communities. So in that situation, we can factor in projected short-term rental income based off of AirDNA. AirDNA.co is very beneficial. So in this specific situation, the short-term rental might have been $4,000 or $5,000 a month. Short-term was showing $100K to $150K. So you're looking at like $10,000 to $12,000 per month. And that made all of the difference to really help out with the rates, with the DSCR ratio, and really get them in. So that helps Pinehurst area, in those mountainy areas that are around resorts, on the beach. This is a huge benefit for them. Another powerful feature of the DSCR is it allows you to go past Fannie Mae and Freddie Mac's 10 property cap. You can only have 10 finance properties in the conventional space. In the DSCR world, you can continue to go past that, and that allows you to continue to build that portfolio. We're going to talk about portfolio loans in the future, but for right now, you could have them all sectioned off in different LLCs for different terms in different areas, and that all works inside what DSCR is. So it really helps scaling without tons of scrutiny of your income or any of those ways, DSCR is huge, and it really helps reduce the documentation hassles that we're so used to in the conventional world. Now, if you're a realtor or a loan officer and you're working with DSCR for the very first time, I'm going to give you a couple of tips to help you get in without being frustrated. The first one is to help your clients prepare the accurate rental income documentation. And so in a normal loan, we're looking at what can that borrower or that buyer afford? And then it kind of applies across almost any house. We'll look at condo fees or something like that might affect that debt to income ratio. But in this situation, the area in which the house is has a much larger effect on will the house qualify for itself or not. And so being able to look at either in the MLS, or I actually like Zillow's rent estimate. The rent estimate seems to be pretty accurate. You can use those to help with getting an accurate picture of what you might be able to see market rent by, because we're going to use what the appraiser uses. It's not just what you have a lease on or what the current seller has a lease for, but we're actually going to be looking at what the market allows. And that's where Zillow's rent estimate or what you see in MLS will be a huge benefit. When it comes to short-term rentals, I'm going to bring it up again. It's the AirDNA. It's a platform that aggregates data for both Airbnb and VRBO and gives very reliable rental projections for those short-term rentals. It's phenomenal. You don't have to pay for it. You can have the free account just to look property by property. But if you're a serious investor or you want to get into investing, I do recommend buying the area in which you want to buy your properties in. And so if you're a realtor, you only work in one area, it might be beneficial to set yourself up as the specialist with investors by buying that and being able to look at short-term rental data for them. Another thing for people that want to partner with that DSCR is know the unique needs of the investors. So for realtors, make sure that your lender knows the different ways to go about things, because every DSCR investor is different. Whether they are 10%, well, there's no 10% down, but 15% down, 20, 25% down, options, do they allow DSCRs under one or above one? Do they allow short-term rentals or not? It's very important that your relationship and your partner has a very good understanding of those things and can make those decisions based on the property that your client wants to buy. It's going to be the easiest thing for all of them to be able to scale their portfolio. Again, it doesn't have to limit at 10. You can go much further than 10. And then for loan officers, if you get that file and they're buying an investment property and you see they already have the 10, look at DSCR. You'd be surprised rates are not that far off if you know how to sell it, if you know how to look at it, if you know how to look at the rate sheet. It's not that far away from where your conventional investment properties are, and in some situations, they're better. So DSCR can be a huge benefit for everything that you have and for all of your clients. So let's wrap it up. DSCR loans are a powerful tool for investors who want to grow their portfolios, and using AirDNA, MLS, Zillow, and getting outside of the conventional sphere of Fannie Mae and Freddie Mac can really help you grow your portfolio of clients and their portfolio of real estate. So if you're a realtor or a loan officer working with investors, understanding DSCR loans can really set you apart. These loans offer your clients flexibility. They help with secure financing on just property cash flow alone. It really gets rid of that hassle. So at the end of all of this, if you found this beneficial and if you like this episode, please share it with your friends, share it with your colleagues that you think might benefit, are looking for more deals out there. This can be a huge way to grow your creative solutions. The more we can empower investors to keep growing, even in challenging markets like this, we can all grow together. So thanks for tuning in to the Beyond the Box, Unlocking Creative Mortgage Solutions. I'll catch you next time.